if you trade Forex, you can build your own pair. So that's strange because I personally heard about it like 2 or 3 times in my life. So I would like first of all to give a demonstration to let you see what I'm talking about. So let's suppose that we are just buying Euro USD and at the same time selling GBP USD. So in the first case, we are just buying Euro and selling USD. In the second case, we are selling Great Britain pound and buying US dollar. So let's analyze the result. If we are selling dollar and buying dollar on the other side, we aren't trading dollar because that's -1 contract, that is +1 contract, that is like if we don't trade dollar at all. So we are just trading Euro versus Great Britain pound. So all of these is just like buying Euro versus Great Britain pound. Let's see a demonstration of that on the chart. So I just created this code to demonstrate what we've just seen. So here we have the price of GBP USD, the price of Euro USD, and the price of Euro USD divided GBP USD, to demonstrate that this value is equal to that value. So let's just see. Okay, that's the demonstration. So as you can see, there is a little difference in terms of the value of GBP USD versus Euro USD and the value of Euro versus GBP. The difference is of 7 pips, and that's simply because having two assets, it's a little different, simply because there is a spread and simply the fact that the CFD markets aren't centralized, so every broker makes his own pair. We could just say something like that to explain that, but as you can see, the price are the same, but we have this little difference that we have to keep in mind when it comes to trading, because it could maybe give you some issues if you are scalpers. So this kind of correlation and the pair trading in general is recommended especially for swing traders, because if you are a scalper, you could maybe have some trouble because of this little difference. So let's say you want to enter long on Euro GBP, and you have to pay $10 every night as a fee, so the swap. But instead of paying $10, that's an example obviously, you could just make your own spread, so entering short on GBP USD and taking $4 as a swap, and entering long on Euro USD, paying $3, and as a result you will just get paid $1 every night for having your operations still going on the market, instead of paying $10 every night for having your operations running. So that's great, especially if it's Wednesday, so you will take like 3 times uh, what what you should take in that case, and you could just get paid only for having your own operations running. So knowing that, it's great. First of all, because you can avoid the commissions, and also you can just study something more about the correlations and how to use it for your trading, especially if you are a swing trader, as I said. But also, it's important because that explains in part why there is such a great correlation between some pairs. Because, for example, GBP/USD and EUR/USD has a really strong correlation, and we will see that in another video that I will post later. And that correlation is in part due to the fact that if you, as we've seen, trade EUR/USD and GBP/USD at the same time, and you build properly the spread, it's like trading another asset, that is, in the case we've studied, Euro-GBP. So that explains, in fact, the mean reverting bias that have the correlations on Forex, and also the pairs. But we will see that later when we will talk about different types of correlation, how to use it properly, and also how could we avoid some issues. If you found this video useful, please click the like button, hit the subscribe button, and share it, because it takes a lot of time to build this video, because I have to think about how to make it comprehensible for other people, and that's not simple for me. So I really appreciate it, and follow me for more content like that, because I will drop a lot of more topics about correlation and also other useful stuff for traders. So see you next time.